Yes, people. In fact, on day one, I had told you that with the chart, all the concepts you should be able to revise within 2 hours. Let's say how much time we take for amalgamation now. And this is the approach I follow all of my topic. Once the topic is over, the entire topic we will revise with the help of our colored chart. Okay. Yes, the first is, let's revise amalgamation of companies. Amalgamation of companies is backed by accounting standard 14. Okay. Amalgamation means what, sir? There could be two types of amalgamation. One company can purchase or absorb another company. That is also accounted as per AS 14. Or two or more companies can come together and form a new company. That is called amalgamation, but still it is accounted as per AS 14 itself. Okay, and as per AS 14, there are two methods through which you can account amalgamation. They are purchase method and merger method. Yes, sir? Okay. If you want to call it as purchase method, in fact, if you want to call it as merger method, or rather merger method is also known as pooling of interest method. For merger method, there are about 5 conditions. What are those 5 conditions? All the assets and liabilities to be taken over, and they should be taken over at book value. Equity shareholders owning minimum 90% face value of equity shares in the selling company should become equity shareholders of purchasing company. Fourth point, PC to the above equity shareholders has to be in equity shares except fractional shares where cash can be paid out. Last, business of the selling company should be intended to be carried out. So if all of them are satisfied, merger, even if one fails, purchase method. Okay. Then purchase method ka steps. What are the steps in purchase method? First, calculate net assets. How do you calculate net assets? All the assets taken over at the agreed value minus outside liabilities taken over at the agreed value. Point number 1. Then calculate PC. PC means what? Amount paid or payable by the purchasing company to the owners of selling company. And who are the owners of selling company? Equity shareholders and preference shareholders. And PC or net asset, we also call it as net worth of the business, or net asset also known as capital employed. And one point we know, if PC is not mentioned in the problem, then net asset itself becomes your purchase consideration. Okay, then compare PC with net assets. Net asset is your net worth. So if PC is greater than net asset, then purchasing company made a loss, which we will call it as goodwill. If PC is lesser than net assets, then purchasing company made a profit, that we call it as capital reserve. Okay, and this goodwill, whatever you get as per AS 14, should be amortized over a period of 5 years as per AS 14 ka requirements. Okay, and under purchase method, will we take over everything of selling company? No, we'll only take over assets and outside liabilities and maybe statutory reserve. But other reserves and surplus are not taken over by the new company. Okay, next is your merger method. In the merger method, what is the first step? Calculate purchase consideration. Is PC calculation any different or same? For purchase method, merger method, PC calculation is the same. Okay, next step is find out the paid up capital. And how do you get paid up capital? Just take equity share capital and add it with preference share capital. That constitutes your paid up capital. Here, paid up capital constitutes your worth. So compare PC with paid up capital. If PC is greater than paid up capital, then purchasing company made a loss. That loss, will we call it as goodwill here, or we'll adjust it in reserve? We'll adjust it in reserve, specifically in general reserve. Okay. Then if it's other way around, if PC is lesser than paid up capital, then in my opinion, it should be capital reserve, which most of them used to do it before. But right now in our study material, you're using what, sir? P&L. I'll get this correction in chart book. Right now I don't have time, but in our examination will not use capital reserve, we'll write P&L. Okay, sir? When they correct it, we'll see. I have told you also to check this in your RTP whenever you attempt your writing. If they have changed that or they've still kept it as it is. If they've kept it as it is, you always write what in exam? P&L. Don't use capital reserve. Okay. Under merger method, what and all will happen? Purchasing company will not only take over assets and liabilities, but they also will take over reserves and surplus of the selling company. Okay. Then we discuss something called mutual owings. Mutual owings means what, sir? Transaction happening between purchasing company and selling company. When you're calculating net assets of individual companies, will you do anything for mutual owings? Will you exclude it, deduct it, add it? Nothing. Think that it is not there and do your normal working. Okay. But in the books of amalgamated company or new company, what will you do this for this mutual owing? You will cancel. And these mutual owings can come in the form of debtor, creditor, bill receivable, bills payable, loan given, loan taken. So basically, what's the cancellation entry for mutual owings in purchasing company books? Liability account debit to asset account. Basically, creditor, bills payable, loan taken account debit to debtor, bill receivable or loan given account. Next is your stock reserve. Stock reserve appears or happens when either purchasing company has sold goods to selling company or selling company has sold goods to the purchasing company. Both the scenario may this could arise. Okay. But what is stock reserve basically? Stock reserve, another name is, you can call it as profit element or loading element, or you can call it as unrealized profit. Stock reserve simply means some profit element included in closing stock. Because purchasing company would have sold to selling company, or for that matter, selling company would have sold to purchasing company, not at cost price, but at the selling price. Okay. So first, what we have to do in the stock reserve, find out the total sale value. Will you eliminate stock reserve from total sale value? No. First check how much of the goods is still remaining in your closing stock. Only on that you need to remove the stock reserve element. Yes, sir, people. Okay, I give you equation also for that. Either you can work it out in percentage or in a format. There is a relationship between profit on cost with profit on sales. If profit is half on cost, it will be 1/3 on sale. 1/3 on cost will be 1/4 on sale. 1/4 on cost will be 1/5 on sale. Either you can use fraction approach, percentage approach, or one box approach, which I had shown you. Whatever you are comfortable, do it. Then what is the journal entry for stock reserve? That depends on the method and scenario. If it is purchase method, and if it's a loss scenario or profit scenario, what will be the entry? Capital reserve to either stock reserve or closing stock. If it's a loss scenario, goodwill account debit to closing stock or stock reserve. If it's a merger method, don't write capital reserve. The entry will be what? P&L account, because is our new study material using capital reserve? No, they're using what? For profit, they're calling it as P&L. So the entry will be P&L account debit to closing stock. If it's a loss scenario, general reserve account debit to closing stock will be the entry for stock reserve. Amalgamation expense. Amalgamation expense is your dissolution expenses, also known as realization expense, liquidation expense, whatever. So if this amalgamation expense is incurred by the purchasing company, then what will be the entry? Again, that depends on the method and it depends on the scenario. If it is purchase method and if it is profit scenario, the entry will be capital reserve to bank. If it's a loss scenario, goodwill to bank. And merger method, you will not use capital reserve. You will simply write the entry as P&L account debit to bank account. This whole thing, I'll change the chart book. I didn't get time. For now, it's okay. Refer that. P&L account debit to bank will be the entry under merger method. Next is for statutory reserve. Under merger method, will you pass any entry for statutory reserve? No, because any which way, all the reserves are anyway taken over. But under the purchase method, should we pass any entry? Yes. What is the entry? Amalgamation adjustment account debit to statutory reserve account. And this amalgamation adjustment account will be shown in the balance sheet under reserves and surplus only as a negative number. I've given you the format of realization account just as a quick reference if you don't have time to go through the problems. This you know of, right? First step is to transfer all the assets at book value to realization account. The entry is realization account debit to sundry assets account at book value. Then transfer all the liabilities at book value to realization account. Then record PC on the credit side. Then you could have amalgamation expense. What is the journal entry for amalgamation expense incurred by the selling company? Realization account debit to bank. Then it will be, if there is a reimbursement means it will be bank account debit to realization account. Then if preference shareholders are paid some excess means, the entry will be realization account debit to preference shareholders account. Any balancing figure in realization account represents either realization profit or realization loss. Will be transferred to equity shareholders itself depending on what it is. Okay, then equity shareholders ka format I have given. If you want as a 7-point checkpoints, we can keep it. One is equity shareholders get equity share capital. They'll get all the reserves and surplus. They'll get miscellaneous expenditure, preliminary expense, or deferred revenue expenditure. Fourth one, realization profit or loss. Fifth one, PC. Then balance cash if any. Final is the total of both the sides of equity shareholders should get matched. That's your format. Okay, sir. Intrinsic value, how to find out? We have already discussed. That is nothing but net assets divided by total number of equity shares. This one you leave it. It's not required. It was some old problems that have brought it in here. It's a problem specific adjustment, not required now. Capital employed, you already know. Capital employed is nothing but your shareholders' funds are also known as net assets. That was your quick revision relating to amalgamation of company. Thank you.